Right, welcome to the Financial Services Club. This is a topic that's near to my heart, and I'm very pleased that we're going to have Robert Barnes and Peter Randall to talk about institutional trading and liquidity in London again. Because when I came to London working for Richard Britton 29 years ago, London was the capital of global dealing in cross-border securities, with over 90% of all global equity trading, cross-border trading, going through the London Stock Exchange. And the size of average trades on LSE was close to $280,000 for the average size trade, where in New York, which was the nearest, it was only $40,000. So that we had just immense depth in the market maker system here in London. And the reason we could have that was that the London Stock Exchange was and is a special institution that does not dictate the methods of trading on the exchange. All other exchanges give you you have to trade under these rules in this way, with this order book and this methodology. London doesn't do that. We allow there are rules, obviously there are rules, but London Stock Exchange allows electronic order books, dark pools, market makers, interdealer brokers, and other execution platforms to all exist in a competitive environment. And it allows investors and brokers to determine where they're going to do their trade executions and achieve best value. And that flexibility, that openness, is what makes London an attractive institutional global capital market. Robert's going to give you chapter and verse on that, but I thought I'd give a little pitch. Now, Robert is to be congratulated for restoring the depth and liquidity in London, because it got destroyed in the 1990s by immediate post-trade transparency, meant that market makers were denied the opportunity to work large trades off their books. Capital regulation meant that they were assessed capital on their book inventory. And the drive for order-driven trading drove a lot of trading into derivatives and less transparent vehicles like ETFs. Now that we've restored deep liquid trading, hopefully we'll see some changes in market structure generally, because I think it would be better for corporate accountability to have direct investment have primacy again. Right, so as ever, we're very grateful to the sponsors of the Financial Services Club, BT and Invest Northern Ireland. This meeting is under Chatham House rule, so no quotes to individuals. And also, please check your phones are tuned to silent, so that we don't get distracted. With that, I am very pleased to introduce our speaker for this evening. Robert is Global Head of Primary Markets at the London Stock Exchange Group and the CEO of Turquoise, which is the European multilateral trading facility, majority owned by London Stock Exchange Group in partnership with its user community, which is itself a collaborative model that's very powerful. Prior to joining Turquoise, Robert worked at UBS for more than 19 years, including as Managing Director of Equities, and he was founding CEO of UBS MTF, which I vaguely remember. His industry roles are very many, with the Securities Trading Committee of London Investment Banking Association, and also as a Chartered Fellow of the Chartered Institute for Securities and Investment. Now I'm just going to mention Peter Randall is going to be our respondent this evening, perhaps challenging Robert on some of what he shows us. Peter is the president of SETL, and which is a distributed ledger technology, that's a central securities depository utility. Let's go there. And Peter is using 21st century technologies to revolutionize the post-trade space. But he has excellent form as a respondent this evening, having been the founder of Chi-X Europe, and also was COO of Instinet Europe, which was the first fully electronic interdealer broker platform. So we're going to have a wonderful, detailed, instructive comment tonight. Oh, sorry. Services Club. Obviously, we do a lot of things. We do about 20 events a year for really magnificent keynote dinners. We also have a daily newsletter, blog, white papers, workshops, and primary research capability. So if you want further research and development, we're happy to cooperate on that. Most of you already probably subscribe to Chris Skinner's blog, which is excellent. It's how I start my day, and it's always worth reading. We also have a huge library of research that's available to you as members online from the merger of Financial Services Club with Long Finance. There are reports on a number of areas available in the library. The ones I track most closely are the Global Financial Centers Index, which is how we keep track of who's rising and falling in the global financial centers stake. And obviously, London is very dependent on retaining its primacy. And then the Global Green Finance Index is a new index that's trying to track with the same sort of discipline the emergence of socially responsible investing and green finance. But there's a lot of great stuff on distributed ledger technology and other things there. One of the reports that's available tonight as you leave is a report on taking the principles of liquidity and applying them to some cryptocurrency markets. Because liquidity is a challenge when you build any market, and it's been a huge challenge for some of the cryptocurrency exchanges who've made perhaps unwise decisions about allowing certain trading into their markets. More than half of all cryptocurrency exchanges have failed and gone out of business just in the 10 years since Bitcoin was first introduced. So it's not a straightforward thing to get right. And with that, I will hand over to Robert.
Well, thank you very much. I'd like to thank the Financial Services Club for inviting a humble practitioner to address such a distinguished audience. In fact, what Kathleen says, I can see many of you in the audience that have been actually instrumental in how our markets are evolved today. I can see Rich Evans, one of the originals in Turquoise, Marcus Fernandez, one of the thought leaders and great traders from UBS, and many others. But what I'd like to share with you today is about the role of the stock exchange in the real economy. Clearly, we play a role in converting risk capital into working capital, and that requires trust in our principles, integrity, innovation, partnership, excellence. Our aim to be the listing and trading venue of choice, and our approach to do this as a community is to raise visibility, do more business, and innovate in partnership with the customers. And the London Stock Exchange has become really a global company for capital formation of the issuance, safekeeping, and trading of securities, the risk management of those securities, and the benchmarking through indices and intellectual property. Here's just a few snapshots. London is more than just a geographic location. It's all of us as a community. In the last decade, $10 trillion raised in capital on London Stock Exchange. FTSE Russell is now clear water ahead of S&P or MSCI. $16 trillion of assets, multi-asset, are benchmarked. And of course, London Clearinghouse has gone through the 1 quadrillion kind of notional number of interest rate swaps derivatives managed by SwapClear in 2018. And when we think about the privilege we have at the heart of the ecosystem, you know, financial centers that connect thrive, it is our privilege to have helped companies and sovereigns from more than 100 countries raise capital. And what the chart is showing on the bars is there are more international companies that have come here to raise capital in London. And the top two numbers at the right are quite fascinating because in 2017, in many ways an all-time record year for London's primary markets, 9 out of 10 of the biggest listings were non-UK companies. 2 of them wrapped as depository receipts in dollars. And last year, another record, that trend continued. 3 out of 5 of the instruments were international. In fact, this morning, it was our great privilege to have our Chancellor, Philip Hammond, open the market with President Jin of the Asian International Investment Bank to raise the first AAA bond of a multinational kind of bank for 25 years. It was really successful. And then, a few hours later, we had another unicorn, Finabra. Anybody that's used Travelex to change your currency, 1.6 billion market cap, is coming to the market from the United Arab Emirates. So the London community, we're here to help make capital raising efficient. Now, we often get asked, when our team is on the road, what about Brexit, right? Is Brexit going to cause a problem? Well, very humbly, the answer is capital raising, underwriting, is completely independent of such a topic. And I just want to raise a few interesting stats for you. That 1,850 equity deals done since the EU referendum vote of 134 billion, 8 different currencies, 2,700 plus debt securities raising over $1.3 trillion, over 640 exchange-traded product listings. But perhaps the more interesting part of the story is the right side of that chart, because 410 of those equity issuances were for 212 international issuers from 53 countries, raising 32 billion. And 1,942 of those debt transactions were actually more international, from 51 countries, and they raised over 725 billion. And of the exchange-traded product listings, over 95% of them are non-UK. So we really are in the international community. And when you look in just Europe alone, that big bar on the left, that's London compared to all the other exchanges in terms of raising capital in Q1 this year. In the top right, you can see the US looks like it's quite big, but I just want to put things into context. The US GDP, its economy, it's 8 times the size of the UK, and yet it only raises about 3 times the proceeds. And in fact, when you take a look at these small and mid caps and micro caps, we're actually parity with New York and NASDAQ. In fact, this is the real economy. This is the small, medium enterprises and others growing. And with the global community working together, the cost of raising capital is far more efficient than it is in America. And our friends in North America are just as active contributing capital here. So if I push the next button, oh, this great picture, this probably puts to bed the Brexit story. You'll see in that circle, the 20th of March, how many people remember that was the day before the original hard Brexit date? Well, here, Coca-Cola European Partners, this is the largest global independent Coca-Cola bottling company in the world, decided on that day to move their $23 billion market cap from Euronext to London. So I don't think anybody would be doing that if they're worried about Brexit. So we'll just move on to the next part. If you look to the right, you can see the breakdown of our investors. The first observation is 49% UK. UK is a massive, very sophisticated fundraising community, all the way to Scotland and everywhere else. But what's the insight? Over half of the investment is coming from outside of the UK, and everybody feels very comfortable to do so. And when we look at the fantastic growth market that 25 years ago was called the unlisted securities market, today the AIM market with about 1,000 companies and continuing to grow. In 2018, when we had MiFID II go live, every exchange that had a growth market could sign up to be a European SME growth market. And it is our great privilege that in Q1 this year, 72% of everything raised in Europe was actually on AIM here in London. So what a great success. Congratulations and thanks for all your support. But really what we want to talk about is the confidence in providing capital, because we know we have all the execution channels to help you get your business done, to buy and sell when you want to. And this picture here shows how the investors, through the intermediary brokers, with one telecom line connection in a world of electronic markets, can access not just London Stock Exchange, but all of the execution channels of Turquoise. That then, at the bottom, you can see we offer a choice of clearing. So the open access, London Clearinghouse, Euro CCP in the Eurozone Netherlands, 6X Clear Switzerland, to provide economies of scale to settle. And you can see the London Stock Exchange. We have the intraday trading of the order book, the bids and offers you know well. The jewel of the closing auction, which is the record of reference for things like exchange-traded funds, passive trading. What's remarkable? I'm sure Marcus Fernandez will remember the size of the closing auction when we were working in the 90s was probably a few percentage. That has now grown to 36% of the daily value in the last moment is the London closing auction. But of course, even though passive indexation is growing very rapidly, assets under management, approximately 80% of asset managers are active stock pickers. And while they love that beautiful liquidity point, they don't only want to be forced into the close. And that's where Turquoise offers the ability to buy and sell earlier in the day. Now, how did we get here? Well, the famous Wise Men report of 2001, commissioned by the European finance ministers, we're really taking a look at this demographic challenge. Developed markets, individuals, getting older, living longer, which is a good thing. But of course, you can't rely on the governments or companies for final salary pensions anymore. So we're witnessing the rise of direct contribution pensions. And when they published this report, they said, notice how the US assets over a period of time were growing about 10%. Europe was only growing 6%. Uh-oh, why? Well, while the US is a big market, it's also relatively straightforward. One currency, one rule book, one settlement destination. Europe is far more interesting, right, with all the different countries, but of course the frictional cost of cross-border clearing and settlement. So the first insight is, if you can reduce the slippage cost, you can probably improve the returns. But just take a look at the top right, 1998. That was the end of the period they were looking at. And I'll just show you some analysis, public analysis from our friends at Credit Suisse, where they said that in 1998, 52% of the turnover on New York Stock Exchange would be of a stock listed on New York Stock Exchange. But with all the fragmentation, you would see that by 2015, much, much less of the turnover is actually taking place on New York or NASDAQ. Now let's just compare that with what's happened in Europe. So MiFID, the Markets and Financial Instruments Directive, went live on the 1st of November 2007. So let's take a look at February 2008, just afterwards. Still 96% of the turnover happening on the primary London. By the time we get to April 2017, still nearly 2/3 of the activity trading on the primary. And probably a big chunk of that is the closing auction, record of reference. Let's kind of zoom in to, let's say, 2019. Look at the left. The LSE's lit order book has now surged last month to 70% of the turnover. Turquoise is another 5%. So what's the insight? 75%, 3/4 of all the turnover of companies that are listed in London are actually surveilled by the same independent London Stock Exchange Group surveillance team. So you can have a lot of confidence in the orderly market. But look to the right, in terms of Europe. Well, we can say London and Borsa Italiana and Turquoise, they're all on one broadly similar technology platform. This is nearly 1/4 of the activity there. We've got CBOE Europe, which has now Chi-X. That was the one that actually, Peter was the one to bring it to the first alternate platform to be the biggest order book in Europe, with great success, which now is part also of BATS and CBOE and BATS and BIDS. You've got Euronext, which is about just under 20%, Zetra 12%. So the insight is, if you're going to conform to your technology, you might as well do it to the London Stock Exchange Group to get the best return if you're going to do that first. Now here's Turquoise, right? So thank you for all of those that have been involved in Turquoise. One connection, trade 99 countries in one go. That's to be providing more efficiency. But one of the things we discussed at the very beginning was also to try and innovate in smart, anonymous block auctioning, because the institutions want to do big size, just as Kathy mentioned at the beginning. And so Turquoise does a lit book, but it also does this TRQM for midpoint. You can trade at the midpoint, and we now also have the TRQA, the lit auctions, which are also pre-trade transparent. But let's just take a look at what this actually means in real life. So here we have a picture of a well-known blue chip, Tesco. This is a single day chart. So on the x-axis from 8 in the morning to 4:30, the y-axis is price. Why have we chosen this picture? Because the price is moving a lot on this particular day. And yet, when we put the Turquoise prices, you can see it looks exactly the same right on top. So the insight is Turquoise, or the alternate venues, are providing a nice proxy for the market data, but not just for UK. How about in Europe? So here's Volkswagen. There's another great big price move. Now, how many people remember in that date in August 2015? That was the naughty day, right, when they got caught for the emissions scandal. Now, actually, Volkswagen is a very well-respected blue chip, but to see such a great intraday volatile move and still see the alternate venue prices right on top shows how efficient, from an electronic trading point of view, everything is kept in line. So this is the point that Kathy mentioned at the beginning. So from our friends Hervey Skeet and Mondovisor did a nice analysis from 1999 to say 2010. London Stock Exchange, at the height of the internet bubble, 1999, £64,000 per ticket. And everything's really converged to about 10,000 euros a trade, or 0.01 million. So the puzzle is, how do we reverse that trend or allow big multi-million trades without having significant market impact to allow the long-term investment returns. Well, I think many people know what an order book looks like. So here at the top, you've got the strip in yellow, the best bid and offer, 100 bid for 1,500 shares, 1415 shares on the offer at 102. Somebody wants to buy 8,000 shares, you have to walk up the book. Your average price will be 102.6, 102.7. But what happens if you also add in an additional execution channel? And here we're looking at another electronic one. This is a midpoint down at the bottom, like Turquoise Plato, where you can actually match at the midpoint. The buyer and seller each get price improvement at 101. Now, I just happened to use a nice example where there's more than 8,000 shares in one go to show you how you get better price improvement at 101. So thanks for the arithmetic example there. But let's just take a look at what the dark pool looks like, because pre-trade, price and size is not displayed. But post-trade, everything's revealed in real time. So here we have a chart from Google Finance. You can take a look, it's in the public domain. Nestle, a well-known Swiss blue chip. And here's Turquoise on the same day, the same shape. The blue diamonds are the Turquoise lit order book trades. The dark circles are the Turquoise midpoint trades. I'm going to zoom in to that red rectangle. And what you can see on the right side of this chart, you see how the price is going up. The increments of the blue lit trades is called a tick size. That's the minimum price increment on the stock exchange. For this example, is 0.05 Swiss francs. And just imagine if we were buying big size and we're having to price average, walking up only in the blue diamonds. Question: are you really getting best execution when you could perhaps also price average with some point in the middle with the dark spaces? Now here's a beautiful picture. 900 people from over 20 countries. This was in 2016 at the FCSI Trading Conference. This is the biggest single-day event with trading experts around the world. I'm sure many of you actually attended this. And here was the first time that live voting was provided to the audience. And the question was, in MiFID II, what do we think is going to happen in 2018? Now, these are not our questions. This is from the actual event. And very pleased to see on the left, 51%, more than half the audience said, more electronic block trading. And then on the right, you may not be able to read this, but they have all these other different venues, and I'm very pleased to see Turquoise got the big bar in the middle. So it seems to be a lot of interest to support us. It actually shouldn't be a surprise because many of the innovations have been designed in partnership with customers. And this is what happens when the customers are with you. You get a great big surge of activity. And this is actually month-by-month activity of the electronic block trading through Turquoise Plato block discovery. It's been if you look at the bottom, you see that UK referendum at the time was a big surprise of volatility. It's actually been dwarfed by the support of the community. It's kind of a Google 10x kind of growth. And let's see what we get next. This is what it looks like when you now enrich the price chart with bubbles that represent the size per trade. And in the middle, you've got these three big blocks, which if we take a look, you can see 1 million, 2 million, 3 million at the midpoint inside the tick size of the lit. So the insight is there's meaningful liquidity. The red circle with that little dot in the middle, that's 0.01 million, that's the average trade size. So if you think about the additional costs of clearing and settlement, which tend to scale with number of tickets, you also get very significant cost efficiencies, maybe 300 times better by actually using some of the blocks rather than just doing lots of little trades. Now here's a case study that was presented to us by the head of a buy-side firm, head of dealing. He said, I'm going to show this to my group CEO because this is going to justify why we want to put more flow into Turquoise. He said, you see this stock, we've been following it for a while, it doesn't really trade, it's like a mist, and on this particular day, Turquoise did 74% of the turnover. That is not the reason why I want to use this as a case study. He said, the reason why, as a buy-side dealer, I wanted to use this as a case study because I was resting my order, not for 90 seconds, not for an hour, you see at the top right, for 4 days, and in his opinion, no information leakage. So this was terrific. Here's an example, Ital Gas from Italy, it had just listed on Borsa Italiana. You can see a nice big beautiful trade of 9 million early in the morning. Remember, all those other little dits, those are the normal average trade size of order books. Why are they so small? Because I think we know in a stochastic model, if you have one large order to buy, a small one to sell, you get a small fill. And over time, that's why the trade sizes are all small. Now here's another interesting example, Blue Chip Next PLC, I think many people know the company. Here we have 5 trades on Turquoise. The top 5 trades represent about 19%. Let's say the closing auction is about 30%. What's the insight? in just 6 trading events, you've got half the day's liquidity. So what that means is in this electronic world, you really need to be active in all the different channels to make sure you get best execution. And what's been happening is over time, we had 1 trade in 2016. Then we started to get a few more trades. Now we're getting multiple trades in a single day of multiple millions. And as we get to last year, we're now getting double-digit million individual trade size compared to the average order book of 0.01 million. So this is really a great testament to the entire community. It's required a change in the buy side to have confidence to put much larger orders to the brokers, and the brokers using the service to make this happen. This is a great testament to how we as a community have been working together. And here we have the Parliamentary Review. This is our distinguished Prime Minister, and we're actually very honored to be selected as an example of best practice. Here's a picture, would you believe it? They actually put one of our bubble charts in the Parliamentary Review. Here's our team. I'm actually very proud of the diversity of our team, winning a few awards up there. But here's a friendly chart from Morgan Stanley showing with the mandatory auto-enrollment of direct contribution pensions, learning from the Australian superannuation scheme, those blue bars, 30 to 40 billion sterling extra demand for equities in the UK, which is contributing to, again, the demand for the supply that's actually coming to the market. And, of course, the FCA in 2017 published a policy statement specifically for direct contribution pension providers. How are you managing your slippage cost? If we can reduce the slippage cost, we improve the returns, and that's good for all of us. It's stressful. Ta-da! Well, I'll come over here and push the button. That's okay. Here we go, some low reversion statistics. Now what's fascinating about this chart? This chart is the way that we actually measure quality of execution. So the puzzle that we're trying to solve is, the price is 2 bid at 4, I think I'm picking the midpoint of 3. Somebody moves the reference price to 3.5, I think the midpoint is 4, I get filled at 4, it reverses to 3. I paid 4, it's worth 3, negative selection. How do we avoid that? Well, actually, the way this is actually measured is, as soon as you trade, you start moving on the x-axis with time, and if the reference price moves, you go up the y-axis. For continuously matching dark pools, middle of the x-axis, after about half a second, 50% of the reference prices have moved. But where you have a functionality like a randomized uncrossing, like Turquoise played a one cross, or some of the other functions, you see even after a second, less than 10% of the reference prices are moving. So what does this mean? This means in the independent analysis of not us, we tend to be matching at a time uncorrelated to the market moves. This is meaning that we're measuring at a time we're least likely to be gained. So this was done in 2015. Here's 2017. Chart looks exactly the same. What's different? 35 times the volume is now going through the pipe. And yet you still see the low price reversion after the trade still working well. And it's continuing in 2019, and this is not liquid metrics, this is big XYT, so you still get the similar analysis, even if you have a different independent venue performance analytics firm. And now with the kind of the periodic lit auctions, the frequent batch auctions, you can see a similar type of low price conversion after the trade, even if we're offering a bit of pre-trade transparency. So the innovation is continuing in the industry, competition amongst all the different venues is helping all this. And I'd just like to finish off a couple of slides. This, I find, is one of the most fascinating empirical insights we get from Turquoise as a pan-European platform. 19 countries, 4,500 securities, and we're starting from January 2013 to last month. On the y-axis, the number of stocks that are actively traded in a month. So when we look to the left, about 1,600 names were active in the beginning of 2013. That's grown to nearly 3,000 names. So the question is, why does this matter? Well, when we realize every day all of the order flow that's put into all of the European exchange order books, approximately 80% of it is concentrated in just 300 blue chips. The fact that this line is going up is suggesting two things. One, investors are also, in addition to blue chips, going down and looking at mid and small caps. And they are succeeding in finding this liquidity in London. Now you can see in the middle of the chart, you see how it surges in the middle. That slope begins to really pick up. That was 2015. How many people remember January 2015, surprise announcement, Swiss National Bank taking the cap off the euro, whoops. And then the next week, the introduction of quantitative easing, which is effectively negative interest rates in continental Europe, in Switzerland, the Nordics, like Japan. And when we consider, or we are told, that culturally, for example, in Germany, people rent property, they don't buy it. In the last 2 decades, as interest rates have come down and house prices have gone up, entire countries of populations have missed out on that wealth-creating asset. And if you have a bit of spare cash and you put it in the bank, you're getting 0, maybe negative interest rates. This is adding to the demand for growth, and that is encouraging more investment in equities, including in mid and small caps, and looking to gain exposure to companies from countries that don't have negative interest rates. And that's part of the reason why we're seeing so much demand in the successful raising for the international companies that are coming here. And we did a very interesting experiment in 2017, which we've continued. We added the top 50 names, now we've done over 100, of the AIM securities, and we just dropped them into Turquoise. And what's interesting is, right away, in the first day, 31 of those 50 names just lit up. So the humble insight is, if you have a consistent workflow and you add some extra symbols, you can actually continue to trade irrespective of size. But look at the benefit you get down at the bottom. In fact, I'm going to zoom up into this chart. The bid-offer spread in the FTSE 100, let's say, is 5 basis points. But the bid-offer spread, the implicit cost of buying and selling, is 10 times that. And if you're able to actually match at the midpoint, you're getting very significant reduction in slippage cost while you're gaining exposure to the liquidity of the small caps, which is really great. And just to give you a few examples of how many people know ASOS, right? A bit of online clothing, right? This company's beautiful case study came to AIM with an $18 million market cap. Today it's a multi-billion market cap. You can see it in that great chart. But we learned something else that was really fascinating. By adding Turquoise, adding the ability to trade at the midpoint, we didn't just see a growth in the midpoint activity, we saw a growth in the lit order book on the primary and in the closing auction on the primary. Same thing, Fevertree. Anybody know Fevertree? Right, Fevertree, another great AIM stock. Came on at a few hundred million, now it's multi-billion. Same observation. In fact, case study after case study shows, kind of like when you have a village and you got one restaurant, or the next village has got 3, you don't want to go to the one with a bit more choice, a bit more buzz, get your business done. And of course, we also had the Plato partnership. We did a beauty parade. I think we've been involved with a number of the community to help us shape the business. This goes to show at least how Turquoise Plato in the UK names has continued to grow. But perhaps most interesting, here's Rosenblatt Securities showing that at least the Turquoise Plato order book, even in a shrinking double volume cap MiFID II dark pool with more entrants into the marketplace, a lot of activity is continuing to concentrate, and absolutely remarkable growth has continued. The dark bars on the right, 2018, 2019, are after MiFID II. So I think if we work together, we have some execution channels to help people get the business done. And I'll just finish off just to show you a picture of kind of many of the people in the team. We're really proud of the diversity of the team that we have, and what's truly remarkable, and Richard, did you ever imagine this when we sat in that original room in Linklaters, that in 10 years we'd go from 0 to over $8 trillion of business traded. So with that, ladies and gentlemen, thank you very much. Thank you.
Wow. How do you follow that? The insight is, Robert Barnes is not a humble practitioner. Robert Barnes is masterful, excellent, and entertaining. And I think we should, for a moment, just celebrate Robert. Yay! I think there's some points and some questions, and I hope some observations which will be helpful. I think the first point that I want to make is that I truly agree with Robert in the observation he made almost at the top of his remarks about that liquidity is a challenge when building any market. Of course it is the challenge. You've got to get the community with you. You might have the technology, you might have the regulation, you've got to get the community. And I think that that would lead me then into kind of like my first question to Robert. That's a question which, you know, he has seen these questions, so this is not, it's not a sort of a dirty trick, as it were. But the first question, Robert, I'd like to ask you is that in the sense that the remarkable improvement in the fortunes of the LSEG from the sort of dark days of the last decade, when we all sat in Old Jury in the Lever committee rooms, which you so ably chaired with John Serapel as the secretary. From those dark days, how much would you attribute the improvement in the fortunes of the LSE to the power of competition?
Well, thank you very much, Peter. I would say that one of the great things about competition is it keeps everyone sharp. And when you're sharp, you have to constantly innovate. I would add that the kind of a corporation, a company has a human condition. And when the human condition of the exchange began to embrace the customers in partnership, that made all the difference in the world. And that I would attribute to the big change. Thank you.
Okay. All right, and I think my next question would be, it's an important question as well from the perspective of the evidence that you laid out in terms of thinking about particularly not just London acting for Vodafone and BT and HSBC and the sort of well-known UK companies, but from the point of view of the cross-listings, do you think that your success in attracting cross-listings, which is undoubted and extraordinary, but do you think that that refers really to investors seeking new pools of liquidity or post-trade certainty, or what sort of elements do you attribute your success to?
Well, thank you very much. Actually, I thought when Kathleen was doing her introduction, she showed a number of the Zien analyses, particularly the International Financial Center reports. I think today there are over 100 active international financial centers. And if you think about, well, what is a financial center? Well, it's obviously capital markets, probably legal dispute resolution, skills and education, infrastructure and financing. But when many of these fast-growing countries, and particularly these countries have younger demographics that complement our older age demographics, they tend to start with debt markets and then they bring equity markets. So I want to give you two very interesting examples last year. As you remember, October to December, the market levels came down dramatically, and yet in November we had two of our most successful listings. In November we had the largest bank listing in Europe, Middle East and Africa, a privatization from Slovenia. And of course they want to do the listing on their domestic capital market, but they also want to have a successful privatization. So it was our great privilege that they selected London as the joint listing destination. 85% of the capital was raised in London by the international community, and when it was our privilege to host the President of Slovenia, a great success, because the capital raised through the ecosystem is straight foreign direct investment back home to make that a success. In the same week, we had Kazatomprom from Kazakhstan, which is the largest landlocked country in the world on the Belt and Road, and Kazatomprom, in the name, has a larger global share of uranium than Saudi Aramco has of oil. When they did their listing, it was the first listing they ever did on their brand new Astana International Financial Center. And again, we were very privileged that they selected London, us as a community, 95% of the capital raised in London, and again seen as a success. So the insight is that financial centers that connect can thrive. I'm hoping you're going to ask a follow-on question, Peter, around, well, what should we do about settlement and distributed ledgers to make things more efficient? But we'll leave that maybe for later.
Couldn't possibly comment. Now, Robert, I was going to go on to sort of say that, although we're friends and we've competed happily together for many years, I think one of the things that the LSEG group has really excelled in the last little while, and particularly since your rise to prominence there, has been the ability to innovate. And I would congratulate you particularly on the low reversion uncross product, because I think that is just brilliant. It's just fantastic. It does offer investors the opportunity to get lower prices when trading securities. And that's kind of what it's all about. It's getting a better price for a fill that you want to do. So I'm very mindful that that's an achievement. I'm also very mindful that, one of your directors, Dr. Wandhofer, Ruth Wandhofer, known to many of us, was there only the other day in some of the social media promoting the LSE as a venue for raising capital. And I'm particularly minded that one of your quite potent competitors, Aquis, has done an extraordinary job at raising capital on the London Stock Exchange, and is doing very well as a business. And that, that must be a bittersweet. Obviously, I wouldn't expect you to comment on it, but a bittersweet opportunity. So
well, I'm actually happy to comment. I would say that the beauty of London as an open access philosophy is to allow all comers. And I think Aquis was a very successful capital raise on AIM. I'm obviously sharing with you hearsay, but I mean, Alistair Haynes, who's one of the other great kind of icons in the industry, I mean, he said what a great moment it was for the company to have the milestone to come and be listed in London in that type of dynamic. And of course, they're trying to innovate, provide competition. That keeps everyone on their toes, and I think that's a good thing.
Excellent, excellent. So one of the points you made right at the start of your remarks was this issue about intermediating risk capital with real capital. And I'd like to just finish my remarks really with one further question. Go back to Xavier Rollet, the previous CEO, and he would famously frequently note that long-term unemployment in the UK was marginally above 2 million people. And yet there were sort of 2.5 million SMEs, and therefore, I'm sure we all agree that you couldn't assume that it would be a one-for-one, but if you were able to get the condition that some of those SMEs were to take on one additional person, that you could do an enormous amount about long-term unemployment for many, many benefits in many, many ways, not least the human cost. But it seems to me that sort of raises the question around the fact that whereas we've got PayPal and others that are able to do micro payments, do we also need a system that's able to do micro capital? And if we do need a system that's able to do micro capital, is that something that the Boffins and the research labs at the LSEG are working on right now?
Well, I would humbly make the observation that progress is an equation. It's motivation plus ability. And we're in the enabling game, and we like to listen and try and respond to that enabling piece, but you also need the motivation piece. And there are actually a number of innovations that we have, and even some of the things we were discussing today, like trading at the midpoint, that, for example, some retail brokers do not offer today. And even when I've done a little bit of secret shopping, I said, can I trade this on Turquoise? I'm like, what's Turquoise? So clearly we have to raise the visibility of that. But the humble insight is, today it has never been easier or more cost efficient to offer choice to the investors of different execution channels to help them get the business done. I think it's incumbent on us to continue to raise the visibility of what we're doing and to work together for that. Thank you very much.
Okay, thank you. Well, ladies and gentlemen, I'll conclude my remarks now with just a small insight and then throw the thing open for broader questions. Back in the day, back in 2007 and 8, when I worked with Robert when he was at UBS, and we did the Chinese experiment, which proved to be, as we know. We had a competitor. It was called Turquoise back then. We used to call it Tortoise, because it went really slowly. And the person that turned the tortoise into the tiger is none other than the humble practitioner, Robert Barnes. So thank you very much. There we go. So questions. I don't know if I'm supposed to be the moderator or Kathleen.
I'll moderate.
You'll moderate. I'll come and sit down. Right. Jolly good.
And yes, we're going to take questions, but I'm going to ask one first because I'm not going to resist an opportunity with these two here. Robert touched on the fact that liquid trading in large size has a dramatic effect on cost structure of trading. That settling one trade for £10 million is much cheaper, easier, and less hassle than settling 1,000 trades of £10,000 each. Because each of those smaller trades is going to have a different price, a different time stamp, will be subject to different settlement conditions, might possibly have occurred over a span of days, so settle on different days. So, how, now that we've reestablished a system that provides primacy to London for dealing in institutional size, with very, very low price impact and very low latency, how can we now enhance that with better post-trade services?
Well, Peter is the master.
You go first.
Well, I'm going to put pressure on both of you.
Well, I make the humble observation that as we see this rising demand for growth, and that growth through equities, and that includes gaining exposure to companies from countries that don't have negative interest rates, we will see more of these dual listings. But I will share the example from UBS. In my UBS days, UBS was one of the first companies, Daimler, SEBA, and UBS, to create a legally fungible global share. Some of you may remember that anywhere in the world would have the same recognition. And yet, UBS at the time listed on Tokyo Stock Exchange, the Swiss Exchange, and New York, ultimately chose to delist from Tokyo. And the question was why? Because here you have three major developed institutional centers. And the humble observation was, when you bought UBS shares in Tokyo in the morning and you sold them in Switzerland in the afternoon, you were not flat. You had two open settlement positions, which required an exceptional manual process to send an instruction, add a fee, take the time, added financing cost. And in a world that's going electronic, where everybody wants everything straight through processed, fully compliant, it had a negative impact on the trading liquidity, the settlement observation. So as a result, UBS delisted. Now today we try to put in all sorts of wrappers like depository receipts, certificates of deposits of interest and others. But ultimately, the humble insight from what we did at Turquoise or Chi-X and elsewhere is that we made very simply the same settlement destination on a per stock basis. So if you buy BMW German shares in London on Turquoise, you sell them on Deutsche Börse, it's Clearstream. If you do it with Nestle shares, it's the same destination in Switzerland. L'Oreal French shares, it's in Europe or France. And that has been one of the reasons why liquidity has been able to grow. So we have learned how smart order routing technology creates a single virtual pool of technology. Why not do the same thing in settlement? And I'm going to give a big tee up to Peter, because he'll be able to explain this, but if we could have the same books and record, even if you have two physical instances of settlement, well, isn't that what distributed ledger does? I mean, the killer application for the internet in the 1990s was the introduction of email. Here's my message, broken up into packets, it's reformed in front of me. You can do exactly the same thing with the distributed ledger, two physical instances and one books and record. I think that would really contribute to liquidity, but let me hand over to the expert.
Well, thank you, Kathleen, thank you, Robert. It seems to me that one of the things that we probably need to sort of bear in mind is that the application of technology in financial services is nothing new. If we go back to the 1970s, it was SWIFT. That was the big story then. In the 1980s, it was the coming together, if you will, of the large processes around putting everything onto electronic ledgers. disintermediation and dematerialization of stocks and bonds. In the 1990s, that was the era of the Euronext, Euroclear and the CLSs and all these great big DTCC systems. The first decade of the 21st century is when 21st century technology hit the trading places. It hit Giants, it hit Turquoise, it hit the London Stock Exchange. That was when we got away from running things COBOL on mainframes. But you know what? COBOL on mainframes, they just went to hide. And the place they went to hide was post-trade. And you will find today that whereas you can do things at lightning speed on Turquoise, sub-millisecond on Turquoise, you can do things at lightning speed in the markets, but when it comes to post-trade, the really, really, really good ones, STP means straight to paper. But most of them, it means send the pigeon. These are people that are running systems that were specified very often in the 1970s. But they've been ka-ching, 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 ka-ching ever since then. These are people that have been running systems that are protected by regulators. These are people that are running systems that look at things from the point of view not of what does the customer want, not what does the end user, the investor need, or the exchange need, but these people are looking at things from what am I prepared to give you? Hardly a great and resilient business model. Now, it seems to me that there is an enormous opportunity using some 21st century technology to be able to allow things that, for example, in London, just let's think about London. When I first joined the city back when, long time ago. When I first joined the city, there was a very active market in Hong Kong names, in Singapore names, in Malaysian names, in Australian names. And you used to describe those names as Singapore Registered London Delivery, SRLD. You used to describe those names in, effectively, Australian Registry London Delivery. Now, as markets became more electronic and order books prevailed, liquidity in London in the Westpacs and the great big RTZs and the non-cross-listed names, RTZ is, of course, is cross-listed, but the ones that weren't cross-listed has just declined. It's gone away, effectively, because it's all moved to Australia, for example. But with a distributed ledger, you could bring that back to London. You could bring that back here, and not just bring it back here, but make it cheaper, more efficient, and smarter. And that, ladies and gentlemen, in my view, I'm a practitioner, that, in my view, actually allows you to think that the opportunity for equities today looks very, very similar. The opportunity, not necessarily the promise, but the opportunity, looks very, very similar to the largest market in the world, the most liquid market in the world, which of course is the global FX market. So these are markets that are trading $5–6 trillion a day. And that's because you've actually got effectively a really very efficient settlement system. I'm not going to be drawn on CLS and all the rest of it, but...
You just made me really happy because I was the domain expert to IBM on CLS development. I was also legal advisor to the CLS founder banks on the legal mechanism. And it's peak $11 trillion a day.
So
yeah.
So we can do it. We can do it here as well. And we can bring that liquidity to London. And if London is where the clients are, guess what? That's where the liquidity will be.
Yeah.
That's my case.
Wow. That was excellent. And now we're going to take questions from the audience, because I'm sure you have some. There's a lot of depth out there. So, can you say who you are?
My name is Patrick. Patrick Spence. I have a question relating to both of you, Dr. Robert and You talk about equities, you talk about being cheaper, you talk about cross-listed. There is a tax in Germany called Auslandskassenverein, which is a 1.5% stamp duty tax. So if you buy BP shares listed in Frankfurt, you have to pay 1.5% extra. Okay? If you buy them in the UK, you have to pay 0.5% tax. I don't really understand the benefit that you're describing, and when you couple that with your charts that you showed, where 80% of your volume is basically ETFs, which are pricing in that Auslandskassenverein tax without me, the consumer, knowing that. Could you explain?
Thank you. Well, I'll try and respond by an empirical example. If you take a look at the bid-offer spread of blue chips in the UK, it's about 5 basis points. If you look at the bid-offer spread of blue chips, which are super liquid, in Hong Kong, it's about 3 to 5 times as wide. And the question is why? And it relates to your comment about, ETFs embedding all the different costs. Derivatives should theoretically reflect all the cost of hedging. But in fact, in London, if you're an intermediary, you get intermediary relief. So you do not have to pay the 50 basis points purchase tax in order to provide that intermediary liquidity. I don't think that is the case in Hong Kong or some of the other Asian markets where the bid-offer spreads are a lot wider. But what is interesting is by thinking about innovating with these execution channels, we could still allow the ability to buy and sell at the midpoint and reduce the slippage cost to give potential price improvement to both sides of the trade very fairly.
Thank you, Dr. Robert. My point is slightly more specific. So if you trade at the midpoint, the purchaser of BP shares in Frankfurt has to pay 1.5% tax. The seller takes a brokerage commission. If that same transaction occurred in London, the purchaser would pay 50 basis points tax. The seller would pay brokerage commission. So I don't really get the globalization point that you were trying to make.
I think it's, if I may, Patrick, I mean, I think it's the point that this is a bit of an old adage, which is that liquidity attracts liquidity. And to the extent that you're able to offer a deeper pool, okay, you may have some tax advantages, you may have some liquidity advantages, you may indeed have some sort of legal advantages, but to the extent that you're able to exploit those, that becomes almost a sort of self-justifying sort of wheel of virtue. And most of the other marketplaces, I mean, you could trade, I mean, you used to be able to trade, what was it, you used to be able to trade ABN, for example, in Singapore. Pay all the taxes. You had a bid-offer spread that was so wide that, you could literally drive an oil tanker through it. It was a huge spread. These things become very, very quickly. The market kind of figures out where you're going to be able to get the best price, and they go there. And so I don't see that the German example is a, that's why Germany is not quite as liquid as it should be, in my view.
Yeah, I would reinforce that. I think it's a rule of physics. Mass attracts mass. Liquidity attracts liquidity. And if you can narrow that spread, the market's going to come to you. We're going to take another question, but I just wanted to add to that Euroclear is beginning to publish actually the metrics that you use are brilliant, by the way, Robert. And the metrics are what really grabbed me, because now that we're measuring and publishing price impact, price effects. And as you say, the regulators have driven this to a certain extent. The value of liquid trading is so obvious. And there is actually movement among the ICSDs to also publish metrics. And I know Euroclear has published a metrics a couple months ago on the basis point funding value of issuing government securities, government bonds that settle through the ICSDs rather than just the local settlement system. And it's a big chunk, big difference, big differential. Because if you're settling through the ICSDs, it's obviously much more efficient for the investors. than if they have to settle with your local depository and have a new structure for doing that. And the more of that value measuring data comes forward, the better quality the innovation is going to be around it. Back there.
Hello, my name is Eric Masaba. I'm from a company called Taxi, which stands for Transit Exchange. I just wanted to bring up the idea of innovation. Would the exchange and the organisations be open to introducing a whole new class of tradable instrument which could increase the global reach of the City of London? I'm thinking about what I would call road space-time pricing. So we've all seen what Uber is, so that's my invention. I filed a patent on all of that, so if anybody's interested, you can come and find me later and ask me about it. But fundamentally, it's something we could trade in London, which would allow road space-time to be sliced up, much like electromagnetic spectrum is. And more importantly, that would allow for dual listings in different countries, because people might want to trade road space-time in a developing country, as well as in London. And this is a way to reduce congestion and move towards more green cities. So what I'm looking to say is, if there is a way to present ideas to your organisation for new types of instrument to be traded, would that be something you'd be interested in?
So, again, Patrick's so electricity, you can trade in 15-minute bursts.
Yep.
So, for example, so it's regulated by a group called SEAQ-I, which is based in Slovenia. They're the European regulator for electricity and gas. You can trade electricity in 15-minute bursts. So, for example, World Cup final, half-time, buy electricity. Everyone's going to make a cup of tea. And you really, so your concept, obviously where you are, your concept is there is precedent that is regulated for precisely what I think you were trying to say.
And funnily enough, that's where I come from. I come from an electricity trading background.
Yeah.
So, okay.
Yeah, I mean, once we have mechanisms, then we can do many more
Well, then they need to
things.
be regulated.
Well, very often, regulations are fact of life.
But the point is as well that in terms of then giving financial effect to that transaction, in terms of settling that financial transaction, as we stand here today, that would require you to build a complete new infrastructure of people to take the risk and to accept the risk and to be able to then transfer the assets one way and the cash the other way. Using 21st century technology, using, let's say, distributed ledger, you could do all that instantly.
Well,
Peter will know that
I'm sure we're going to have
entirely means cat here.
we are going to have a lively conversation downstairs. I have been so privileged to chair this event with Robert Barnes and Peter Randall, and I hope you will join me in that.